Welcome to a quick video on how to buy real estate in cash, then become your own bank. This is the HELOC method. So right now, roughly 1 in 4 US home sales closes in cash. No financing contingency, no appraisal risk, no lender delays. Cash offers win deals, finance buyers lose. But all cash locks your capital in one property. That's the fear. So unless you know the next move, buy in cash, then use a HELOC to recycle that equity across multiple purchases, becoming your own bank, essentially. Let's get in. I'm Mick Wadley, founder of Gap Funded. We help real estate investors and business acquirers access the capital they need to close deals and scale their portfolios every single day without equity splits, without draining savings, and without giving up profit. So if you want a free funding review, soft pull, no hard credit check, 2 minutes, link in the description below. So let's go close something. And let's get into the HELOC method for becoming your own bank. So why does cash actually win the deal? Fewer contingencies, so no appraisal gap, no lender stalling, no buyer backing out 3 days before the close. It's faster closing. So in competitive markets, certainty is worth more to sellers than higher financed offers. And the problem, 2 or 3 cash deals and you're sitting on properties instead of liquidity. That's where the HELOC strategy comes in. So here's the core strategy of becoming your own bank in real estate, mapped out A to Z. First, we buy in cash. Then we go and open up a HELOC, place a HELOC on that existing property. You can do this on a home you want to live in or investment properties owned by your LLC as well. Then we go and draw those funds. So use the HELOC to buy the next property in cash. You can typically draw about 80% of the equity in the home you just bought in cash. We pay down that HELOC once we've exited. So we reduce the HELOC via rent, refinance, or sale. Typically, we want a near-term equity play like a fix and flip, BRRRR method, a cash out refinance if you have to, and reset the line. So we draw the HELOC for the next purchase. One revolving facility secured against existing equity funds, cash purchase after every cash purchase. So most HELOCs allow interest-only payments during the draw period, keeping monthly obligations low while the line stays available, as opposed to a refinance or a HE loan where you're paying interest and principal for the entire term, no matter when you're utilizing that line of cash or not. So the mistake almost every article makes is the HELOC versus delayed financing. So the benefit of a HELOC is it's revolving credit. You can get interest-only payments, same facility resets as you pay down, so you're not paying closing costs every time you use it, and can be placed on any owned property. Ideal for recycling capital across multiple purchases, as opposed to delayed financing. So Fannie Mae exception, fixed loan amount and rate, amortizing payments, capped at 70 to 80% LTV, and it's not revolving. So ideal for pulling capital back out of one specific property fast. So these are not the same tool. Using the wrong one costs you money and flexibility. Delayed financing, this is a fixed cash out refinance exception. Pull capital back from one property fast, whereas the HELOC is revolving interest only in many cases. Sometimes it's just for the first year, but you can get a lot done in that first year. Recycle capital across multiple cash purchases, and typically you can get payback terms of 20 to 30 years on these as well. So how recycling actually works. Let's look at a 400K property owned outright, no mortgage, because you bought it in cash. We got a 280K HELOC available. Say it's an investment property. We can go up to 90% LTV on a property you intend to live in, a home. But for an investment property, it'll be 70% LTV with an interest-only draw period. So let's go off the investment property example. On the next deal, you got a 220K cash purchase. Distressed property, offer accepted over finance bids. After rehab and tenant placement 6 months down the line, you refinance into a DSCR loan at 75% LTV, pulling out 180K to 200K to pay down the HELOC, and the line resets, you rinse and repeat. So a 1.3K monthly payment, interest only at 7 to 7.5%. So when this doesn't work, and this is the risk side to be aware of. So the variable rates, HELOC rates are variable. If rates rise while you carry a large balance, your interest only payment increases. Model with a buffer, not just today's rate. You've got your equity risk. If the market drops, your available HELOC line can shrink or get frozen. Sometimes with little warning, never draw to the absolute maximum if you can avoid it, unless you've got a very near-term equity play like a fix and flip. Repayment discipline. You need rental income or a clear refinance path to pay the HELOC down. Without it, you're accumulating debt across multiple properties, a very different and riskier option. So the qualification requirements, this is as of 2026. This is always changing quarter to quarter, but what lenders are looking for is a credit score of 700 plus, best terms, some programs to 680. This is on an LLC owned investment property. LTV cap will be 70 to 75%. If it's a home, they'll go up to 90% on aggressive lenders. 6 months of cash reserves, debt to income under 45 to 50%, and where to find them. So most major national banks do not offer HELOCs on non-owner occupied properties. Look to investment property HELOC lenders, regional banks, credit unions, shop multiple lenders. Look where you've got existing relationships established. Availability and terms vary significantly. So the bottom line is cash wins the deal. Cash offers eliminate financing risk and win in competitive markets. HELOC recycles that capital, revolving interest only periods, fund multiple cash purchases from one equity pool, and don't confuse the tools. Delayed financing, fixed, one time. HELOC is revolving and repeatable without multiple closing costs. If you want to know if you already have enough equity to start, book a free funding review, soft pull, no hard credit check, 2 minutes, let's go close something.